Okay, so in this series of videos, we're going to take a look at financial statement analysis and ratio analysis. Those are kind of synonymous. And we're going to see how that relates to firms, how we can use these tools to get some insights into how a firm is performing. And from a managerial perspective, maybe get some insights into things we can work to improve on as managers. So ratio analysis, what we're going to be looking at are the relationships between balance sheet, information on the balance sheet items, and income statement items. And depending on the ratio, it may be a relationship between two balance sheet numbers, two income statement numbers, and then some ratios are relationships between a balance sheet item and an income statement item. This goes back to the financial statement information that you guys looked at in a previous chapter. It's important to know where this information is found, which financial statement has the information that's necessary. All right, so we're going to use ratios to, again, help tell a story about the firm. We're going to use them to get insights into what is going on with the firm. We're rarely going to just look at one ratio to get the story for a firm, but what we're going to do is look at the holistic picture painted by a number of ratios from various categories that give us some insights into the firm. So let's start looking at some of those categories. The first one is a category that measures the liquidity of the firm, the firm's ability to pay its bills in the near term, and especially over the next year. So the first ratio that we're going to look at, the first liquidity ratio, it's a very common one, is the current ratio, and that's defined as the current assets divided by the current liabilities. Now, I do want to have a little aside here. The definitions that I'm showing you, or the book shows you, are maybe common definitions, but they're not the only definition out there. There are a lot of ratios that we won't talk about, believe it or not. You'll probably be overwhelmed at the end of these videos as we talk through maybe 20 different ratios. There's a lot we're not going to talk about, but there's a lot of ratios out there, and they have various definitions. If you go to 10 different websites, you might get 3 or 4 different definitions. The important thing with ratios is to pick the definition that you like, that you want to use, that makes sense and is going to help you understand the firm's performance, and then use that ratio definition consistently. As long as you're doing that across time or between firms, then you'll get the qualitative information that you need to get. So when I say definition, this is the one that we'll use, but there are other possible definitions out there. So the current ratio, again, current assets over current liabilities. The quick ratio is very similar, except we're going to take out that part of current assets that is the least liquid. So inventory is the least liquid piece. We're still left with cash and accounts receivable. Those are kind of the 3 main current assets. So current assets over current liabilities, and then current assets less inventory over current liabilities. And what I want to do now is take a little detour and look at the ratios. We're going to compute some of these ratios for 2 different firms. We're going to look at Home Depot and Lowe's, and I'm going to put this spreadsheet up in Blackboard for you, and you can kind of follow along. But we're going to compute each of these ratios, and let me go down here to the current ratio and the quick ratio. We're going to do that for Home Depot and for Lowe's. Actually, I'm going to do it for Home Depot, and I'll let you do it for Lowe's. So there's 8 other tabs in this spreadsheet that has information on Lowe's and Home Depot. So we're going to do Home Depot. We're going to calculate the current ratio in 2006. So again, it's defined as the current assets over current liabilities. Both of those numbers are found in the balance sheet. So I'm going to put a little formula here, equals, and then I'm going to go to the Home Depot balance sheet, and that shows up down here at the bottom. So if I go to HD/balance sheet, that's where I'm going to have the information I need. And I'm going to go to current assets, and that is right here, total current assets. I'm going to divide that by the current liabilities, and that number is down here at the bottom. You can see it's labeled as total current liabilities. So we've got a formula that has the current assets over current liabilities. I'm going to hit enter, and I get a result of 1.19. And the nice thing about using spreadsheets to do these calculations and putting in formulas to do these calculations is that I can now copy the information across, and it's using the same formula, and I've got a little bit of a picture now as to how Home Depot's liquidity has been evolving over time. So let's just talk real quickly about what a current ratio means. It's basically the items that are going to turn into cash over the next year divided by those items that you're going to have to pay in the next year. So it's, again, a liquidity measure. We would like it to be above 1, because that says you're going to have enough stuff turning into cash to pay the things that you're required to pay over the course of the next year. So below 1 starts to get a little scary, possibly scary. Again, we're never going to look at just one ratio. But we also don't want to have a number that's too high. We'll talk a little bit more about that later, but we could have numbers that are too high. If we had a number in the current ratio and it was 10, for instance, we had 10 times as many current assets as we have current liabilities, we may have too much liquidity, we may have too much cash, too much money tied up in current assets that aren't really being productive, and it's going to hurt us elsewhere. So in this case, let's just look at the story here. The liquidity has improved since 2006. The ratio has gone up, especially in the more recent years, since 2009. And in 2013, the liquidity measure, the current ratio was 1.4. So we have 1.4 times as many current assets as the current liabilities, 1.4 times more things that are going to be turning into dollars than we have obligations over the next year. So that's the current ratio. The quick ratio is very similar. It's going to be the current assets less inventory, and then we're going to divide that by current liabilities. So again, I'm going to go back to the Home Depot balance sheet, and I'm going to highlight total current assets. I'm going to subtract inventory, and then divide that by current liabilities. And generally that number is going to be less. If inventory is a positive number, we're going to have a smaller quick ratio. We don't have quite the same issue with it needing to be 1, but in general, the higher the better. So if we're comparing a 0.23 quick ratio to a 0.39 ratio, we would say that the firm is more liquid, has higher liquidity with the higher number. And typically that's going to be consistent with the current ratio. So they tell kind of qualitatively the same stories. They give us the same insights and the same pictures of the firm's liquidity. Just slightly different views on it. And as I'm looking right now at the difference between those two numbers, it's a pretty substantial. And so one thing that tells me is that the firm has a lot of inventory, and inventory is a big deal. Inventory is a big part of the firm's current assets, and that has implications for the operations of the firm. With this much inventory, and again, let's just look at the balance sheet. The inventory for Home Depot in any given year is $10 to $11 billion. So that's a big number. It's a lot of money tied up in inventory. The firm will want to have some very robust measures to keep track of inventory, to control inventory, to make sure inventory is not walking away, to prevent obsolescence of inventory. So this just raises a whole lot of issues, and in looking at these numbers and these ratios, it kind of highlights some of those things. So we've not gone very far, but this will be our first video, and I'll pick up in the next video with the next set of ratios, the asset management ratios, and we'll do that in video 2.